If you have been watching your portfolio grow over the last few years, and you think that means you are protected from the next market crash, I need to show you something. The protection you think you have is almost certainly not what you think it is. Here is the uncomfortable truth that most financial content will not tell you directly. A portfolio that has grown from $300,000 to $500,000 over a 5-year bull market has not become safer. It has become more expensive. And in about right? The same in a market crash, the same percentage decline takes more dollars from you than it would have when the portfolio was smaller. A 30% decline on a $300,000 portfolio costs you $90,000. A 30% decline on that same portfolio after it has grown to $500,000 costs you $150,000. Your exposure to dollar losses has increased by $60,000, even though you have not changed a single position. This is the first thing most people get wrong about crash protection. They measure risk in percentages and forget that the actual dollars at stake have grown along with the market. Now let me show you the second thing that almost nobody factors into their planning: the sequence of returns risk. This is the specific danger that a market crash hits right when you start withdrawing money in retirement. And it is the single biggest mathematical threat to a retirement portfolio. Imagine you retire with $500,000 and you plan to withdraw 4% per year, adjusted for inflation. In a normal market environment where returns average 7% annually, your portfolio lasts about 30 years. That is the standard 4% rule scenario. But if a 30% crash happens in your first year of retirement, your $500,000 becomes $350,000. If you still withdraw $20,000 that year adjusted for inflation, you are now pulling nearly 6% of the remaining portfolio. The math on recovery becomes dramatically harder because you are withdrawing from a smaller base. The portfolio that suffered a first-year crash runs out of money roughly 10 to 15 years earlier than the one that experienced steady returns. That is sequence of returns risk. And here is the part that genuinely worries me about where we are right now. The Shiller-Cape ratio, which measures stock prices relative to 10-year average earnings, is currently above 35. It has only been this high twice before in history. 1929, right before the Great Depression, and 2000, right before the dot-com crash. A high Cape ratio does not predict exactly when a crash will happen. But historically, it has been strongly correlated with lower returns over the following 10 to 15 years. The last time the Cape was above 30, the S&P 500 returned approximately 0% total over the following decade. So what do you actually do about this? The answer is not to sell everything and hide in cash, because inflation will eat that cash while you wait. The answer is to build actual protection into your portfolio before you need it. And that means 3 specific things. I know nobody wants to own bonds in 2026. They have had a terrible decade relative to stocks, and the yield still feels low compared to what you get from dividend stocks. But But bonds are not in your portfolio to outperform stocks. They are there to not crash when stocks crash. During the 2008 financial crisis, when the S&P 500 fell 37%, long-term U.S. Treasury bonds returned approximately 26%. During the COVID crash in March 2020, when stocks fell 34% in a month, long-term treasuries gained about 20%. Bonds are crash insurance, and you buy insurance before the fire, not during it. The U.S. stock market has dramatically outperformed international markets for the last 15 years. As a result, most American investors have almost no international exposure. That is performance chasing, dressed up as patriotism. But here is what the data actually shows. There have been multiple decade-long periods where international stocks outperformed U.S. stocks. If the next decade is one of those periods, being 100% U.S. stocks will significantly underperform global diversification. Third, cash as a strategic asset, not just an emergency fund. I am not talking about panic selling into cash. I am talking about maintaining a deliberate cash position between 5 and 15% of your portfolio, specifically to deploy during market crashes. When the market drops 30% and everyone else is panic selling, you want to be the person with dry powder buying assets at a discount. That is not market timing. That is having a plan for volatility before it arrives. And the final piece that almost nobody implements is what is called a bond tent. In the 5 to 10 years leading up to retirement, you gradually increase your bond allocation to somewhere between 40 and 50%. Then, in the first 5 to 10 years of retirement, you gradually spend down those bonds to fund your withdrawals, allowing your stocks to recover from any early crashes. This is the actual mathematical solution to sequence of returns risk. It is just rarely explained because it is less exciting than picking stocks. Here is what I want you to do this week. Go look at your actual portfolio allocation. Not what you think it is. Not what you set it to 5 years ago. What it actually is right now after years of stock outperformance. If your stock allocation has drifted 10 or 15 percentage points above your target because stocks have gone up so much, you are not as protected as you think you are. Buy the protection now while stocks are high and bonds are relatively cheap.